Hi, my name is Miguel Unsueta, and I want to talk about some contemporary ways of thinking about the way managers and leaders make ethical decisions. So, there's a very traditional way of studying ethics, which is trying to understand prescriptions behind ethical decision making. So, you can think back to fields like philosophy, and what ethics scholars there try to do is figure out how people are supposed to act. There's been a much more contemporary take on ethics where psychologists and behavioral economists are trying to understand not what people should do, but rather what aspects of the situation cause people to behave badly, why we behave contrary to our best intentions. One question that this more contemporary study of ethics has tried to answer is why do people ignore unethical behavior? And I'll be talking about two distinct reasons why we ignore unethical behavior. The first is motivated blindness, which is the tendency to look the other way when it's not convenient to notice certain things. And then there's outcome bias, which I'll explain what it is in just a little bit. Let me give you a quick definition. So when I use the word bias, I'm using it in a psychological sense. So specifically, I'm referring to cognitive biases, which are tendencies to think in particular ways that can lead to systematic deviations from what would be considered to be a rational or good judgment. So it's tendencies from what would otherwise be considered good or rational. Now, motivated blindness is a tendency to overlook unethical behavior when it's not in our interest to notice such behavior. So the picture here has an ostrich with its head in the sand that you can argue can also apply to a person who wants to bury their head when they don't want to notice troubling information in the environment. Now, the psychology behind motivated blindness is that people with a self-interest to not notice certain information cannot and usually do not view this situation without bias. So we are incredibly good at turning a blind eye when it's convenient for us to do so. There are examples of motivated blindness in all aspects of human behavior, but one really interesting example comes out from the world of business. So some of you might recognize this logo that I have up on the screen. This is, of course, the logo for Enron, which was an energy company that declared bankruptcy in 2001 in the United States. In fact, in October of that year, Enron reported $618 million in losses, which at the time was the biggest ever reported set of losses for an American company. Now, it came out in months after that statement came out. It became clear that Enron was engaging in questionable business practices. Frankly, they were engaging in outright fraud. And so the question became, well, how could this be possible when Enron is getting audited by an accounting firm? An independent accounting firm actually audits and monitors how this company is supposed to be doing. Well, the problem with the relationship between the auditor, which was a company known as Arthur Andersen, and Enron, is that Enron was also responsible for hiring that company. So if Arthur Andersen were to actually call Enron out for engaging in questionable reporting practices, Arthur Andersen feared being fired by Enron. And so what's interesting is that this is a situation where Arthur Andersen, as a company, was motivated not to look too closely at Enron's financials for fear of losing Enron's business. And so in the aftermath of Enron, people in the United States really started thinking about the way that accounting firms and corporations relate to each other. Is it really okay for a company to hire their own auditors, or should we try to foster more independence between the people or the companies being monitored and the people that are supposed to be doing the monitoring? So this is again a situation where Arthur Andersen was motivated to turn a blind eye to Enron's questionable reporting practices. Now, a related bias in psychology that allows people to overlook unethical actions is this outcome bias. Now, the outcome bias is a tendency to take results into account way more than is logically justified in order to assess whether or not the decision was good or not. There's been some really interesting studies that find that if people guess correctly at a game that is purely based on chance, people who are watching this assume that the person who guessed correctly was simply smarter or engaged in better decision making. when that's impossible for actual decision making to have played a role. The game was purely based on chance. So what ends up happening is that if things work out well, we tend to assume the person engaged in a good practice, in a good and ethical and sound decision making process. When things turn out poorly, we tend to assume the person engaged in a poor decision making process. And so unfortunately, what the outcome bias causes us to do is to give way too much weight to the way decisions work out, not to the process that led to that decision in the first place. And of course, what ends up happening is we tend to punish unlucky negative outcomes and reward lucky positive outcomes. Now, why does this matter? Well, the tendency to weigh outcomes more heavily than is logical in determining whether or not a decision was good or not means that we wait way too long to condemn unethical behavior. Even if you have suspicions that certain processes are underway that are probably going to work out poorly, we're going to wait and see how they're going to work out. And if things work out well, we're likely to ignore the problematic processes that were in place that could potentially lead to an unethical or a bad decision. So when it comes to the way this applies to the world of business, it really took major financial reporting scandals at Enron, WorldCom, and Tyco in the early 2000s to really motivate the American government to do something about addressing underlying conflicts of interest. It wasn't until Enron collapsed that people seriously started thinking about how accounting firms are relating to corporations they're supposed to be monitoring and evaluating. There are some factors that breed unethical behavior inside of organizations. Whenever there's uncertainty in how people are supposed to act, people can be very clever at downplaying the ethical implications of a decision. So unless a manager or a leader goes out of his or her way to explain that certain things are out of bounds, certain decisions are unethical and not okay, people are going to be very clever at just rationalizing away the potential ethicality of a decision if it plays into their self-interest. Also, in those kinds of environments, you're likely to look around and just do what everybody else is doing. So if nobody in the organization seems to have any kind of qualm about a decision that feels like it has ethical connotations, you are going to assume that it's perfectly okay. So again, it's really important to eliminate that uncertainty and just state outright what is ethical and what is not to get people to act in accordance to the organization's values. There's also been evidence suggesting that when people are under time pressure, they are simply way too preoccupied cognitively to really think through the ethical consequences of their decision making. So it's important to keep in mind that when there is high stress and high time pressure, people are more likely to engage in unethical decisions than when there is more time to really think through a decision. Short-term time horizons also play a huge role. When people are focused on the here and now, when they're focused, let's say, on getting an incentive that is immediately accessible to them, people allow their self-interest to take over. There's also been evidence finding that the more isolation occurs within an organization, be it individual isolation or departmental isolation, what you find then is that these isolated or siloed divisions develop their own norms as to what is ethical and what is not. And so what we find is that isolated individuals and groups are more likely to develop norms that deviate from the organization's values. So it's really important to keep everybody together in the loop to prevent individual unethical norms from developing in these isolated parts of the organization. In terms of strategies to help facilitate ethical behavior, there's a couple of things you can do. The first thing is to try to anticipate when self-interest might force you or encourage you to do things that you would otherwise consider unethical. So think about the scenarios where you might be tempted to take a shortcut that would be considered unethical by your organization, and then think about how you're going to react to that temptation. So things you can do is mentally picture yourself acting in the ethical manner, which is conducive with the organization's values. You can also rehearse responses to these ethical situations, right? You can think about how you will turn down the immediate payoff to do the quote-unquote right thing according to the organization's values. You can also use pre-commitment devices where you simply announce to the world that you will not engage in certain types of practices, right? These public commitments will actually help keep people on this ethical track when they are tempted to deviate from it later on. It's also really important to give voice to the part of ourselves that cares about behaving in an ethical manner. There's been some interesting research finding that if you get people to focus on the high-level aspects of a decision, they're more likely to act in the right way. So, for example, consider a situation where you're thinking about lying to get something in return. Let's say you're trying to negotiate with your current employer and you're tempted to lie about having an attractive outside job offer when you really don't. A way of making yourself think more abstractly about this particular ethical decision is to think about the way the game is supposed to be played, right? So negotiation with your employer, it's totally normative and totally expected, but think about the rules that are supposed to guide this action, right? You expect your employer to treat you honestly, and in return, you're supposed to also negotiate in an honest and respectful manner. So once you start thinking abstractly about the way negotiations are supposed to be done, that is with both parties engaging in honest information sharing, you start realizing that lying truly is wrong. And if you can take yourself out of the short-term temptation of lying to get a raise, you realize that there are certain rules that need to be abided by in order for you to negotiate. So again, think about what rules you're supposed to play by to negotiate, and also think about the kinds of behaviors and practices your organization would want you to follow. Again, these are ways of thinking more abstractly about the decision you're trying to make, and it's also a way of putting short-term temptation on the sidelines while you consider the rules that you're supposed to operate by. Another very simple way of thinking about decisions is if you have any kind of concern that what you're about to do is unethical, just imagine yourself calling up your grandmother and telling her exactly what you did. So in the example I gave on the previous slide, imagine you do lie to your employer about having an outside job offer and you do get a raise. Can you imagine yourself calling up your grandmother and telling her that you lied to get a raise? I would expect that most of our grandmothers would not find that to be behavior that is acceptable, and most of us would think twice about doing this if we start thinking in these ways. So the grandma test can help you get outside of the moment and think about what exactly you're doing when it comes to these ethical decisions. A couple other ideas for facilitating ethical behavior. It's important, especially for managers and leaders of organizations, to identify hidden but powerful informal values. So what does the organization say it values versus what actually guides people at work, right? If the organization talks about the importance of doing high quality work, yet all employees seem to talk about or care about is money, that might suggest a disconnect between the organizational values and what is actually driving behavior at work. It's also important to ask who's actually in charge here. So there's a great example of Ford in the 1970s. This car that I'm showing you up here is the Ford Pinto, which is now a notorious and infamous car, in that it was riddled with all sorts of engineering and safety hazards. And unfortunately, what was happening in Ford in the 70s is that they were so concerned with selling cars that it was salespeople in the organization that dictated when cars went to market. And engineers really had no power, or very little power, and not a lot of say about design flaws in these vehicles. So it was this quest to just try to sell more and more cars that actually drove Ford to put out these cars that were dangerous and not ready for market. In terms of facilitating ethical behavior, again, it's important to ask, what are people actually talking about at work? What kind of slogans are repeated at Ford? A common slogan that was heard in the organization in the 70s during the Pinto era was that safety doesn't sell, which again should be a clue that it's in fact the sales department that was in charge of decision making at Ford, not the engineers, who would have the most to say about safety and engineering quality. Also, pay attention to what isn't talked about in the organization. So here's a quote from a former employee of Arthur Andersen, which is the firm that was responsible for auditing Enron at the time of Enron's collapse. So she says, "We were supposedly the guardians of the public trust, but no one ever talked about that. everyone did, however, talk about making money all the time. So it was clear that at Arthur Andersen, at the time of the Enron collapse, this quest for making money and making profits really overtook the underlying purpose of this organization, which is to guard the public against corporate fraud. So to summarize, sometimes people overlook unethical actions without necessarily realizing it. Again, the idea of motivated blindness, when you have a vested interest and not noticing something, we're incredibly good at turning a blind eye. And also outcome bias. We tend to wait to see how things turn out before we determine whether or not processes were good or bad. So it's really important to be mindful of that and to really think through processes and to also try to take self-interest out of the equation when you're trying to get people to act in ethical ways. Now, in terms of what encourages unethical behavior in organizations, uncertainty as to what is ethical and what is not, time pressure, focus on the short term, and isolation can make unethical behavior more common. And again, one way of trying to help people think about unethical connotations of a decision is to encourage them to think abstractly about the way a game is supposed to be played or the kinds of values that are supposed to guide the way you make decisions on a daily basis at work.